Hi, hello, welcome friends. In this video, I am going to discuss about investment banking classes. So, what I am discussing past complete one class is completed. Now, come to second class. What are we are going to discuss about in second class? I will focus on equity capital, debt capital, and returns, risk, interest rate, and liquidity, money market and market-based securities, face value, coupon rate, interest rates, fixed rates, and floating rates, reinvestment risk, credit risk, market risk and interest accrual and clean price and dirty price. This is the concept in second class. So we have completed first class. Now we are going to second class. So firstly we will brief recap of first class what we had discussed. So in first class we have discussed about investment banking. What is meant by investment banking? So in what is the syllabus? Investment banking syllabus will be equity derivatives, debt and primary market, secondary market, currency market, anti-money laundering, trading, corporate actions, research analysis. And whereas fund accounting, it has a mutual funds, private equity, hedge funds, etc, etc. And job roles. What are the job roles? IPO, portfolio, advisory services, mergers and acquisition, valuation, raising capital, etc. Next up, what is meant by IB means, that is investment banking means, this is the persons who can raise the capital and they can advise the capital structure and they will advise the mergers and acquisition and they will rise in low cost and in less risk, that we have discussed in IB means. Next we will discuss about AMC, that is asset management company. Asset management company who is the institutions who will pool money from investors and invest in the market and they will charge the fees. So they will focus on retail customers. This is AMC means. And we are discussing last concept will be wealth management. What is meant by wealth management? Wealth management means this is the persons who will focus on high net worth individual persons. So that the concept of AM, the wealth management company. These are focused on first class. Now I am going to second class. So if you want to first class, I will provide the link in comment box and in description, so you can go for first class, you can see the video and you can get the update of what is there in first class. So now come to the second class. So welcome to all, welcome for investment banking classes. So now I am going to start what is there in second concept. So second class I will go first what we had ended with wealth management. So wealth management means that it deals in advising individual clients who is the persons, high net worth persons, and they will take based on risk ability, what is the risk ability and expected returns and wealth advisory. They will individually they will mentor and individually they will explain, individually they will focus, so that persons, and they are also based on their incomes and based on their age and whereas how much risk they can take, and whereas the fees, wealth management charge fees will be high because they will provide the customized solution to individual customers. And whereas global market and AB operations and stock broking operations, in this division these companies deals what they deal like retail investors and mutual funds, etc. Where investment banking operations will deal retail investors and mutual funds. Investment banking companies will or brokers help the investor open demat account and trading accounts and help in buying, selling securities like shares, debentures, technical stock exchange for the businesses, and they earn brokers. So normally this angel broking zero, the what they will do, they will allow to open the account and they will charge brokerage for buying and brokerage for selling. That's the concept they will do. And example, for example, if you are buying 20 lakhs shares of Reliance Jio company in stock exchange, so you will pay 1,500 rupees or 1,000 rupees, etc., etc., as a broker charges to technical stockbroker who is person giving services na, that angel booking or Zerodha, etc., etc., that other person, and they will have separate research team. So they will maintain the research team. These divisions conduct research about equity and equity shares, fixed income securities like bonds, commercial papers, and commodities like gold, crude oil, and currencies like US dollars and rupees, etc. And research can help the funds to invest the money and to advise the investors where to invest. So they will help the investors to invest money, where to invest money, and where to. They will also advise the persons. Next, retail banking, lending, mortgage, etc. What is this retail marketing lending agency? Most of these investment banking companies have other financial products or services like dealing in lending, and means they will provide the giving loans and mortgaging the loans, so home loans, etc., and dealing with credit cards. These are also some retail bankings will do. Next, for example, if you are advising a friend who want to start a business, so you will need to explain about what is source, what is the type of capital you can raise, that is equity capital you can raise or debt capital you can raise to start a business or to expand a business. Owners of the business or a promoter need more capital, so they need capital. Example, 20 lakhs or 50 lakhs, 100 lakhs, whatever the amount they need. So if you have your own capital, you can invest, and if you do not have the capital, and you can ask for others to invest in big business as a owner. This concept is known as equity capital. In this case, gain or loss shared between the owner or equity shareholders, whatever their proportion equity share they purchase. For example, if you have 10 investors and you need amount related to 20 lakhs amount, so 20 lakhs amount you need, so 10% investors, so 2 lakhs, 2 lakhs, 2 lakhs equity shares. And if you earn the profit of 10 lakhs, you will share in that ratios only. So this is one side. And if you do not coming to the relative ownership, owners will always get the dividend or reinvest if in case in the loss is there, all investor will lose their capital, that is the equity capital of PT. And other source will be, means there is no guaranteed income like interest and that paid by the company. There is no concept of fixed income in case of equity share capital. And whereas if you come to the debt capital, in this case, if you are business owner, you can borrow money from others and issuing the debentures and bonds. So you can issue the bonds or debentures at 10 rupees or 100 rupees, etc. If you want to borrowing 10 lakhs rupees or 20 lakhs rupees, you can issue 2 lakh debentures or at the rate of 10 rupees per bond. Or if your friend has 1 lakh rupee and he may purchase some bonds, 50,000 bonds, he will purchase it at the rate of 10 rupees. Now he can get from the company. Company will promise that interest payment at like 10% or 12% must be paid even if the company make losses. So in case of equity, they no will provide any guarantee. They don't provide any fixed rate of income. So, and whereas the debenture, they will provide the guarantee by paying interest amount at the rate of 10%, 12%. So even if the company makes the loss, and they also promise repayment of principal after 3 years or after 5 years or other term, they may repay the company's amount. So this is equity and debt concept. And whereas after that, what we should know now, in case if you are in case if you go for business like equity or debt, so who can decide whether you can go for equity or debentures, debt? So this will advise the investment banking persons who is providing services, investment banking operations. Next, if investor has more money, that is more liquidity. Liquidity means what? Liquidity means easily convertible into cash. This is meant by liquidity. And due to low interest in technical business or more growth, they can raise capital by seeing shares, so that may after that option and sell at higher price also. So if you have a surplus funds, they are interested to invest. And if the market conditions are negative or market is falling or liquidity is low, better they will avoid rising equity and capital by issuing bond or debentures. So if they raise the capital, they have may opt the case high prices. If the market conditions is negative or market is falling or liquidity is low, or they can avoid the equity capital, they go for equity capital, they will go for issuing the bonds and debentures. Sometimes business may predict good growth, so if revenue may be high, and however they may fail to achieve due to slow economic boom or due to corona, this unspecifically reasons, then they may fall to repay the debt or pay interest in time, or so rising more debt is risky. So if you are rising more debt, then it will be more risky to the persons. For example, if you are a company or a real estate company, you are predicting more growth 2020, but suddenly this corona was came, so they have taken more loans from banks or persons, and they started new projects. Due to corona, they are unable to sell the houses, and their default has happened in 2 years, 3 years. They are that damage may reputation company, repeat the company, so it will damage company's reputation, and they may fall to raise any additional capital in the market. It can lead to liquidation of that company. So if you are going for any loans, any additional capital, they don't invest any person. Generally investors and market experts measure the debt equity ratios, like ideal ratio is there 2:1 ratio, or that ideal ratio. So they may feel for accept that ratios will be acceptable level is there or not, is there any behind more risk, that they will see when they are investing. And if the, for example, if Infosys company has 10,000 crores equity and 20,000 debt capital, so it means what is this, two times of debt equity is there, equity ratio is 2:1, so debt by equity ratio will be maintained. So it is depends on technique expected return. So what is the expected return on capital or return on capital employed is based on these two terms, that is expected return on capital or return on capital employed. If a company is expecting 20% or 30% return or 20 crores profit on 100 crores investment, they can borrow interest either 8% or 10%. They need to pay the interest 10 crores, and remaining profits, whatever the remaining profits, for example 5 lakhs or 10 lakhs or 20 lakhs or 10 crores, whatever the remaining profits after paying to the borrowing, that it will enjoy by the company. If company is not sure about expected returns, so then they avoid debt, since interest payment is must even if they lost the company. So if the company is not able to think what the profit will be come from the business, then they don't go for debt, because even if company is making loss, they need to pay the debt interest amount. So if the company is not sure about the expected return, they don't go for debt. And companies also take other points consideration before taking any decision, that is equity capital or whether capital, which capital will be used. So we need to consider the expected returns, what is our expected returns, and existing debt in the company, already how much debt is there, and interest rates in the company, and expected returns, near future expected returns, what is the near future expected return, and liquidity in that market to know if this is the right time to raise the capital. So these 4 points must see before going for any equity or debt. What is that expected return and existing debt capital and interest rate and liquidity of that company. If investor has more money, if investor has more money in the market, that is more liquidity. So if you have more money, it is more liquidity. Due to low interest rate in technical economy, more growth in that company, then they can raise the capital by seeing the shares may opt for that option and sell higher prices. So, for example, if you have in market, so you are paying 10% interest rate, and suddenly the interest rates fall in other side, so 8%. So what they do, they will repay that this 10% interest rate bond, and they will purchase the 8% interest, so they will pay the less amount now, so that risk will be there. See the liquidity also. So market, if market conditions are negative or market is falling or liquidity is low, better they can avoid raising equity capital and they go for debt capital by issuing the bonds and debentures. Sometimes business may predict good growth in revenue, so if you are in good growth in revenue, then they will go for equity. Next, some types of, so some bonds, debt market or fixed income market depends on issuer, means it will go for, like if your company is a government company, they risk will be less and they may issue tenure, so company will decide tenure will be, they may issue for less than 1 year bond or more than 1 year bond, depends on their risk and repayment risk, and they will do. So some of them are money market instruments, or government bonds, or guild bonds, or corporate bonds, or debentures, or municipal bonds, and mortgage based securities, etc. etc. So money market instruments, these securities which less than 1 year maturity, like treasury bonds, commercial papers, and certificate of deposits, etc. etc. These are money market instruments. Next, government bonds or gilt bonds, which is issued by the government, which have less risk of repayment. So government means they don't have any risk, so risk of repayment will be less. And the corporate bonds or debentures issued by the company. So like Bharati Airtel and Jio, etc. etc. This is corporate bonds and debenture bonds. Municipal bonds. Municipal bonds means issued by the municipal corporations like KMC or HMC, Hyderabad Municipal Corporation or Kurnool Municipal Corporation, etc. etc. Mumbai Municipal Corporation, etc. These municipal bonds will be issued. Next, mortgage-based securities. Mortgage-based securities means if you are in a loan, so if company has one loan, so they are will issue the securities instead of repaying the amount to that bonds. So through that loan, for example, company has taken some loan from some bank. So if ICICI given a bank to Reliance Jio of 1 crore, and they will convert that loan into securities, that is 1 lakh rupee of 100 per security, then ICICI will get the interest. They will treat it as debenture holder. They will not treat it as money lender. Now pay to interest every basis. So this is borrowing by issuing the bonds or shares, whatever the bonds is there. The mortgage based securities will converted into securities. Next, have from company perspective, there are what are the capital sources or securities they can use. So what can they use? They can go for equity shares, they can go for preference shares, they can go for debentures or bonds, they can go for commercial papers. So I am using the words debentures and bonds. Is it different? Is there in debentures or bonds in USA? In USA, whatever the bonds is there, they have only two types of bonds. One bond will be government related bond, so government bond. Another will be corporate bonds. So if the any other company other than government is issuing, that is related to, they will say that companies bonds. They don't they venture or they, so they will tell it is companies bonds, corporate bonds, and if the government is issued, then it will be government bonds. This is false concept, and in India we use debentures like that, and commercial papers, etc. So these are capital sources and securities company may use, that is equity shares, debentures or bonds, preference shares, commercial papers, etc. etc. For example, if you have one friend and you want to start a business or you want to extend his business, he can go for equity and he can go for debt. So now if you are advising, so you need to explain about equity and you need to explain about debt capital. And if you are starting and expanding and first ownership, person who is the owner, and if the person is required 20 lakhs or 10 crores or 100 lakh crores, 10 lakhs, etc., etc., depends on their type of business and size of the business. And if they go for their own capital, if you have an own capital, they can easily invest, they can easily introduce in the business. And if you are not have enough cash, they can ask for other to invest that business as a owner. So if you are asking for others to invest as like as a owner, it is known as equity share capital. And in case of gains or in case of losses, shared between the owner or equity shareholders, whatever the loss will come, they can share. Whatever the gain they came, they can share in this between persons. For example, if you have 10 investors or owners started a business of any business, food delivery business, or example, the capital is 20 lakhs registered in that person's companies, and they will issue 2 lakhs bonds at the rate of face value 10 rupees per share. And if the company earn 10 lakhs, they will share that 10 lakhs rupees to that person in the form of dividend, or it can may reinvest that 10 lakhs amount as for further profits. This is known as equity concept. Now if you are going for equity, that is equity, there is no guaranteed amount, so there will no guaranteed amount, they will no provide any guaranteed interest amount. So if company loses, all investors will lose the money. If company ends, all investors will gain from that company's perspective. Now if you are advising capital is better, company should understand this risk and return. If you are telling about you need to go for capital, then in equity capital risk is less, no guaranteed income, only dividend payments is there, no repayment in guaranteed to investors. And if company made profit, then you may go for, so they may more likely to they will repay 50%, and in 50% they may reinvest. So all profits are going to investors only. If you are in saying that go for a debt capital, in debt capital always a risk is more, since interest should be paid at a regular time. So if you person invested in a debt debentures, you company will need to pay the interest, even company earn profit or loss, they don't bother about your company's profit or loss. So you need to pay the interest, they need to pay. And year monthly bonds, monthly or yearly, or they may quarterly, they may say at the time of issuing that bonds. So principal should be repaid after a certain maturity time, that is like 5 years bonds or 10 years bonds or 3 years bonds, whatever the bonds they may. So here no need to pay the amount of profits. Here how listed companies like Infosys or Reliance, etc., etc., they may decide or fix the capital or capital. So it depends, so it will depends on the expected return on capital or return capital employed. If the company is 20% return, they will see first what is the their what is their expected returns and existing returns, interest, liquidity, etc., etc., that based on their investor. And next here some key terms, we will know the some key terms, that is what is meant by debt securities. Debt securities, these securities are instruments in the market like bonds, debentures, commercial papers, etc., etc. So if the government issuing the bonds, they will no create bonds like 1 crore bonds at 100 rupees or 1000 rupees or 2000 rupees, etc., etc. The company or government will repay the interest at the year. in each year they must repay. At the maturity time, they will repay the principal amount. Some persons sometimes by what is they can do, these securities will be transferable. They mean it has liquidity. Liquidity means what? Freely convertible into cash. It is known as liquidity. So liquidity means, for example, how company is able to honor its commitment. They will say how they will realizing the capital, realizing the amount from trade receivables, how much time they are taking. They will see how they investing that surplus fund existing in the company. They will see, and how company is going investing pattern. This all will see for the liquidity of the company in the cases. Next, so these securities will be transferable and liquidity. It is easy to raise the capital and companies. For example, if you are person, you are want to sell the bonds, so you can sell, and other person will receive the interest, whatever the amount, market value and repayment amounts. If you are purchasing debentures or bonds for some company, and they will pay the money back in term, so you don't need to wait at the time of maturity. So if you want to transfer to other person, you can transfer the bonds. Next, some terms will be money market. What is mean by money market? So money market instruments means this is a security with less than 1 year maturity, like treasury bills, commercial papers, certificate of deposit, etc., etc. These are money market instruments. And whereas government bonds or gilt bonds, it will be issued by the government and it has less risk of repayment. Next, corporate bonds, already discussed. Corporate bonds means municipal bonds, corporate bonds, debenture bonds, mortgage bonds, securities, etc., etc. Now, here I will explain about face value. I will explain about corporate rate or interest rate. What is meant by face value? Face value means this is the principal amount. This is the principal amount of bond or debenture or company or government issuer, who is the person issuer of securities, receive this amount from investors. So from investors they will receive this amount, and this amount will be paid by the issuer to the investor at time of maturity. So at starting time they will receive, at maturity time they will repay this amount, whatever the amount they will receive. Now this is a face value. For example, if Infosys company is there, they need 200 crores amount, they may issue the bonds, 2 crores debentures or bonds they may issue at 100 rupees, and they will give the interest rate at the rate of 10% or 20%, 12% they may charge, and it will pay the interest regularly, that is quarterly or semi-annually, etc., etc. At the maturity term, they will repay the principal amount, that is face value, whatever the face value. Even market value will be changed. They don't bother about market value, because if you are taking any loan from any bank 10 lakh rupees, for example, if you taken any loan amount 10 lakh rupees, after 3 years loan terms was changed in other persons, they know to want, so they will repay, means whatever the loan amount, principal amount you have taken, principal amount need to pay 10 lakhs only, they don't ask more amount. That is the case. And whereas coupon rate means what? Interest rate means what? Coupon rate, if company or government issuer who is the issuing debt instruments like debentures, bonds, they borrow from public, so they can pay some interest also to the investors. So not like as shares where the company can pay dividends. If you have purchased the shares now, they will pay the dividend, they don't pay the interest amounts. So here in debt market they will pay the interest. So for that they need one rate. Now that rate is known as coupon rate and interest rate. Even company is in loss, they must pay. For this purpose, they have two types of rates. They may pay in a fixed rate interest, or they may pay for floating rate interest. Fixed rate of interest. Normally governments give fixed rate of interest, 8% interest, 9% interest, 10% interest, like etc. etc. That is fixed rate of interest. And whereas floating rate of interest means this will different amount of interest will pay to the investor. Like now they will start with a 6% rate, and after 8% they may pay. So this is based on, they will give the, they will pay the interest based on repo rate or Libor rate, or Libor plus 1%, that the floating rate interest related. So they may decide fixed rate interest or floating rate interest, which interest we can pay. So they will see based on their company risk and company returns. Next, tenure or maturity date. What is the tenure or maturity date? Each of these debt instruments will have tenure like 3 months, 1 year, 10 years, etc. etc. This means issuer of the security like company, Infosys company or any other company will repay the principal, or we can say that face value of the security of the company, tenure and maturity date, they will repay the principal amount. This principal amount known as face value, and this tenure will known as maturity date. That is the case. Next, can this tenure will be in number of days or years? So they may have number of days also. For example, we have see 90 days bonds, that is commercial papers, etc. etc. So generally these bonds or debentures will may issue for 1 day to 100 years. More commonly issue for 90 days bonds, and they will see. And can these bonds risk, what are the risks is there? So for if the company has more tenure now, based on more tenure they have different types of risk. One will be credit risk or default risk. If you have more time, sometimes company's credit will be decreased. Credit risk means what? If a company issued bonds and not able to repay the principal or interest, that credit risk. That is credit risk. When the investor is investing in bonds, they will check the repayment capacity of the company. So investors always check the repayment capacity of the company and if they invest. So if for example, if you are invested in Infosys company's bonds today, and the tenure will be 2 years, and invested in that company, they have enough assets. So you will see the enough assets. If company has profit, they will repay. Even if company has no profit, they will repay by selling their assets. So that if the tenure will be like 5 years, 10 years, 30 years, credit risk also will be increases. So more tenure, more risk will be there. So you will choose for company. Or if you are in given that bonds will be government bonds, then risk will be less. You must trust the company. So that company, to understand the risk, investors will know the credit risk na. For credit risk, investor will go for credit rating companies, which will be provided by Credit or Fitch, S&P, Moody, etc. etc. They will provide the credit rating like AA, triple A plus or triple A minus. So you see the credit risk. Based on that credit risk, you may interest repayment capacity is good or not. You will see. Next, after the credit risk, you know about the reinvestment risk. In sometimes bonds like callable bonds, investor may find difficult to reinvest the bonds and get the same interest receiving earlier. So they get lesser income in some cases. For example, if you are invested in Serum Chit Finance bonds in 2023, you are getting 9% bonds. For life, it will be 5 years. After 5 years, you are repaying by the bonds, and now they will providing market interest rate will be 7%. So 9% you have received. Now the rate will be 7%, so you may lose the 2%. This is a reinvestment risk. So next, interest rate risk means interest rate risk in that company always changes due to inflation in the market. So interest rate will be changed due to inflation in the market. And money supply, what is the money supply? This is the main factor for interest rate risk, that is inflation and in the market and money supply in the market. And if you are invested, for example, if you are invested in 10 years bonds in 2020, you will get same rate for 10% for 10 years. So at the time of issuing only, they will take these bonds is 10% bonds and 10 years message. So at the time of 10 years, you may get the same rate of interest. Sometimes in middle, other companies may interest rate will be changed. You will lose that opportunity to add the more interest. So this is the risk will be there in sometimes. It is interest rate risk. Next, market risk. Market risk means based on company, market price will of the securities will change based on demand and supply of the bonds. So if you have more demand, then security price will be more. If you have more supply, then price will be decreased. For example, Chiramchit Finance Company is there. They are selling bonds and debentures at 1,000 rupees per debenture. They trade 1,050 rupees in 2024. If more demand, reason can be changed. Interest rate or change in credit rating or repayment capacity of the company. So this market risk is more in long-term bonds. Since interest rates or credit rating will be changing, so investor will decide intention. What is the intention? If you are intention to sell the bonds, if you want to need, if you have any need of money, your intention to sell the bond, when the price increase to market, risk is always there. So if investor wait the up to maturity, they will get the face value and principal back. So if you stay at end, you will get the all principal amount. Next, interest accrual concept. What is interest accrual concept? For example, if you are purchasing any government bonds and they will pay interest semi-annually or quarterly, etc. in middle. For example, they are paying May and December interest. So if you are selling bond at April. So in April you are selling means that bond contains interest accrued for 4 months. If you sell that bonds and at 31st May, government will pay the interest. We have name of bonds, so that new buyer will get that interest amount, full interest amount for 6 months interest. So you need to sell at a selling price plus interest accrued amount. That is interest accrual concept. So you need to add that interest amount. Now we know that two concepts. One is clean price and one is dirty price. What is mean by clean price? What is mean by dirty price? It is like a invoice with GST, invoice without GST. So if invoice sale price include GST na, include GST, or sometimes sale excluding GST. Excluding GST means what they will do, sale plus 18%. Is this, for example, 100 rupees plus 18%, 18 rupees they will charge it. So bond value will be 100 plus 18 will be the interest accrue. That is 118 is the price. That is clean price. For example, if you see dirty price means interest is included in the price. You are taking 100 rupees and you are giving the part, means 100 into 18 divided by 118, that is dirty price related concept. This is the case will be interest and dirty price, this concept. So totally we have discussed this investment banking related topics.